Hi, everyone. You are joining ETF and Fund Regulation Part 2, the first 4 months of 2025. I'm Bibb Strench, co-founder of ETF BILD, along with John Jacobs, who's actually here off camera, and Rich Keary and Justin Mice. We are a forum for kind of more small, mid-sized ETFs. We do a variety of things, including hosting webinars like today. So today we're at the Investment Company Institute headquarters. We're a few blocks away from the White House, the Oval Office, where Paul Atkins was sworn in by Treasury Secretary Scott Bessent and Donald Trump a few days ago. And so this is part two. Part one, we hosted this back in October. We didn't know who the president was going to be. We didn't know which way the House was going to go. Now we have a lot more clarity. And so let me just begin by introducing my two panelists who will give kind of brief backgrounds. Why don't I start with you, Lisa?
Great, thanks, Bibb. Thanks to ETF BILD, John, Bibb, Thompson, Hine for hosting us. We really appreciate being here. My name is Lisa Hammond. I am the Associate Managing Director of the Independent Directors Council, which is the part of the ICI that focuses on fund directors. I've been here for a number of years, probably more than I care to count. But prior to that, I practiced law with a law firm in town, Morgan Lewis, focusing on investment management. I started my career at Fidelity Investments up in Boston, my hometown. So happy to be here.
And how about you, Jane?
Sure. So I echo what Lisa just said in terms of thank you very much for inviting us back. So I'm Jane Heinrichs. I am with Federated Hermes. I'm head of the U.S. Regulatory Affairs. I'm the only one actually in DC from Federated Hermes. And despite my title, I also do increasingly more and more global issues. So before Federated, I actually worked with Lisa for 18 years at ICI. I was in the legal department, and I focused primarily on money market funds and ETFs among many issues. So again, thank you. This is terrific to be back.
Yeah, glad to have you back. Thanks, Jane and Lisa. So, let's start with kind of the obvious. Since we're here at the ICI, we have Lisa, what the members of the ICI are focused on. I know the ICI sent a letter to Paul Atkins on April 14th, kind of going through a list of items that they would like to see addressed. So why don't you just start out very general? What's going to be the focus of the ICI?
Sure, we can do that. Let's start out with kind of the regulatory environment that we're in now. Sure. I think everybody knows, as Bibb said, Atkins was sworn in earlier this week, so he's just a few days into the job, and he's coming into an environment, I would say, unlike one we've seen, that I've seen in my career. So we are seeing a lot of executive orders from the Office of the President. They seem to come fast and furious, but I think we can bundle them all in a number of themes, right? There seems to be an effort to have more alignment between the executive branch and agencies like the SEC that have statutorily been designated as independent. There seems to be a stronger push collectively to deregulate. And I think all of this kind of results in a slower rulemaking process because there are all these procedural delays. So by way of example, one of the more noteworthy executive orders that I saw calls for kind of a 10-to-1 rollback, which requires you to or not you, but federal agencies to identify 10 regulations for repeal, 10 existing regulations for any new regulation that they want to put forward. And this isn't just for the SEC specifically, it's for all federal agencies. But for the SEC, it's a big deal. I think that it takes a lot of people to deregulate, and with everything else we're seeing going on now in the regulatory environment with buyouts and a kind of encouragement for people to leave federal government service, you're seeing the exodus of a lot of more experienced professionals at the SEC, and so it's going to be harder to get that work done, and I think we'll talk more about that later.
I was just gonna, just to add to what Lisa said, there was a couple of directives from the administration earlier this month that I think are sort of interesting. Again, along the same theme, deregulation. So the president issued another memorandum April 9th that focused on agency deregulation, and then another executive order focused on reducing anti-competitive regulatory barriers. And what's interesting about these is the memorandum, again, sort of like what he did earlier in February, directs all agencies, including the traditional independent agencies, and that would include the SEC, to review all of their regulations for consistency with law and administration policy. So there's a lot of emphasis on that. They are looking, for instance, specifically at all the court cases that Lisa and I actually discussed in October. They're asking the agencies, you know what, we need you to go through your regulations to make sure that not only are they consistent with the APA, but are they also consistent with the more recent court cases? Also what's interesting is that the memorandum appears to direct agencies to undertake repeals of some of the rules without notice and comment. And if you know anything about the APA, you generally need notice and comment to do anything. There are exceptions to that, and the memorandum sort of spells that out, but there is a real push for them to just do this as quickly as possible and just kind of put the APA aside. Lastly, the order to reduce the anti-competitive regulatory barriers directs all federal agencies to complete a review of regulations and identify for future revocation those that limit competition. So they're clearly looking at things that not only they would say violate the APA or inconsistent with judicial decisions, but also things that might be anti-competitive. So that clearly can continue to see this deregulatory emphasis.
And the APA is the Procedures Act that kind of governs the rulemaking process at the SEC.
Which has always been sort of the Bible that everybody's been following.
And lawyers.
And the lawyers, exactly.
So it probably goes without saying that the rulemaking process and agenda will look really different going forward. So a lot of the proposals that we had seen under Gensler, cybersecurity, ESG, a lot of those are either dead, which we always say nothing's ever really dead, but they've fallen off the agenda and they're not top priorities. We'll see other things maybe reemerge. We'll talk more about crypto later on, but things like that will just look a lot different. We'll talk about the SEC's task force and other things going on to kind of foster innovation. We'll see things like an encouragement or an expanding access to private markets, reducing burdens on publicly traded companies. But I think we'll see a backlash against things like ESG. Some of the things with Gensler that were kind of hot topics are not going to be hot topics anymore. And even by the end of Gensler's term, you saw things falling off, swing pricing, liquidity, things that were very gung-ho that took a lot of our time, maybe just a couple of years ago, kind of really did die down. I think we'll see kind of a back to basics approach. In Atkins' recent statements, he talks about protecting investors from fraud. And so when we look at examinations and enforcement from the SEC, we'll see things like an emphasis on disclosure. We'll see them bringing cases where there is fraud, but I think we'll see less of the one-off cases like the off-channel communications or things like that. We might see those as add-on violations if the SEC is in examining other things and they see those violations, but I don't think that they will be the primary driver of sweeps or examinations. So that's kind of what's going on with rulemaking. I think the SEC's Division of Investment Management, the Chief Counsel's Office, has kind of seen an increase, a reemergence of that group's kind of, I don't want to say relevance, but yeah, I mean, they're getting more headline news now. I think it had gotten quiet. We'll talk a lot about ETF share class in a bit, but you know, co-investments, there's just been a lot of news out of that group. I think over the last several years, it's really been rulemaking that has kind of set policy. You know, you often hear the phrase, you know, rulemaking by enforcement or policy by rulemaking. I think we'll see less of that. We'll see more exemptive relief process taking the forefront, and then rulemaking, you know, after the fact, kind of like we did for ETFs to begin with, or money market funds. I think you'll see innovation in a more historically typical process. So the SEC's willingness to kind of use the exemptive relief process, to use guidance, to use more typical avenues for policy, I think will allow it to do more in the coming years. So I guess back to the original question, after all of that, what is ICI doing? I think most immediately, we're trying to get relief from some of the things that we've seen in the recent past. And I think the best example of that is the Names Rule. We did see the extension of a compliance date, which is great, but we're looking for more, right? We're looking for a flat out repeal. At the least, we're looking for FAQs that will kind of help settle the compliance burdens. But I would say there's general discontent with the Names Rule and figuring out how to comply with it. And so we are trying to kind of see an unwinding of those amendments. And then also we'll go on offense to try to modernize the 40 Act. The ICI has undertaken a multi-year project with our members as well as outside counsel to try to figure out what's kind of ripe for the modernization. So all of that is, I think it can be boiled down in a number of different ways, including ETF innovation, which means ETF share class relief, which we're starting to see now, an expansion of semi-transparent ETFs, expanding retail investors' access to private markets, eliminating unnecessary costs and burdens. We'll talk about e-delivery, proxy voting reform, better leveraging the expertise and independence of fund boards, a subject near and dear to my heart. So I get lots of questions about in-person voting and things like that. So, you know, the ICI issued this huge white paper that kind of sets forth, I think, about 20 different initiatives, and sent a letter, I think that's what you referenced, Bib, to Atkins. And it's something that we've been preparing for quite a while before this election, waiting until the time is right, until we had somebody like Atkins in place who seems open and eager to kind of innovate a little bit.
Yeah, that's a great overview. And, you know, one of the reasons I'm optimistic is, you know, Paul Atkins. You know, first of all, he speaks 40 Act, and I don't think we've ever had a chairman that spoke 40 Act. I first ran across Paul when he was at PricewaterhouseCoopers, and they were doing, him and Larry Friend were doing consulting for the mutual fund industry. And then you add on, you know, he worked for a chairman at the SEC, he was a commissioner. So he doesn't need to do anything to, or he doesn't need to learn on the job. He knows how to navigate. So I think conversations with groups like the ICI likely will be productive. So another thing we have in Washington, we have congressmen, senators, and Jane, anything kind of percolating on the legislative front?
Sure. So I'll start off with one, and then I'll fund it to Lisa. So I'll just talk about one thing that we're looking at a little bit is the stablecoin legislation, which is pretty interesting. That both the House and the Senate have very similar bills. They've gone through the committee, and I believe that they're waiting for floor votes. And they're interesting because, especially as a money market fund shop, Federated Hermes, these are important for funds and as well as money market funds, especially because the bills would explicitly permit stablecoin issuers to use certain money market funds as acceptable reserves. So that is it's a new avenue for money market funds. So I think that's kind of exciting. It also obviously gives some guardrails around stablecoin issuers. They can only have reserves that are highly liquid, such as cash, treasuries, that sort of thing. So we're watching that, and I think that's part of the larger crypto digital asset framework that is being put in place by the legislation through the Congress as well as the SEC and CFTC. So Lisa, do you want to talk about the other ones?
Yeah, there are a bunch of things. I guess I'll call out a couple. E-delivery, I mentioned briefly. It was recently reintroduced in the House, not yet in the Senate, but it's been attached to a few House hearings, and that kind of paves the way for a markup. And then after the markup, hopefully it will go to the floor for a full vote. So we're optimistic that we'll see something. The ICI has been working really hard on this for a number of years. I think it's something that would save the industry quite a bit of money. And so that is a very high priority for our members. And I think
But the SEC could do this themselves,
right,
right?
right. So
That
it's
would be
kind of a
good, yeah.
dual path, right?
Right.
But Atkins has a lot on his mind, and I'm not sure it's front and center, but I think it's consistent with the goals he set forth. And so I think that he would be open to it. And so there's certainly that opportunity. And so we're kind of attacking it from both tracks, trying to get some leverage there. And so hopefully we'll see something, I don't want to predict when, but hopefully sometime soon. Also, the Growth Act is something that we're watching. That was recently introduced. The bill would defer taxation of automatically reinvested capital gain distributions for traditional mutual funds until shareholders actually sell their shares. So that would kind of put the tax treatment of traditional mutual funds on par with standalone ETFs. The prognosis for that is a little bit it's an uphill battle, I think, when we're in an environment where folks are looking to kind of capture revenue and instead of cut more revenue. So that can be a little bit tricky, but I think that it's something that would really help the mutual fund industry. Of course, there's also the risk that it kind of shines a light on ETFs, and we all kind of remember the Wyden bill and the prospects of capturing more revenue from the industry, I think, can be attractive to some. So we'll be watching that carefully.
Yeah, and you have to realize there's a thin majority for the Republicans in both chambers, and they're not necessarily all going to vote in line. So some of these bills would be a challenge making it to President Trump.
Right. We are supportive of that. So.
Yes, and I think the whole industry obviously is. Before we leave money market funds, money market funds are talking about amazing products. Money market fund ETF, these have been hugely innovative and have helped Americans, consumers, everybody. But every round of money market fund regulation seems to be ratcheting down what a money market fund can invest in. But the industry is innovating, like you alluded to, Jane, and not just on what a money market fund can hold, but there actually is a money market fund out there that you can invest in with tokens, not cash.
Right.
Anything worth discussing on that front?
Yeah, so just a couple things. So the last round of money market fund reform was in 2023, and just to kind of point at that, what it sort of did to the industry, pretty much reduced the prime money market fund industry by 60%. So it's huge. It was a huge blow to the prime money market fund industry, and that's just because the new onerous requirements that are required for a prime institutional fund. But the good news, I think, as Bib was mentioning, is that there are some new tokenized money market funds, and what basically the term tokenization is the process of creating a digital representation, which is a token of a real thing. So in this case, it's a fund. So you're taking a fund, you're not changing anything that you do with it or what it invests on, but you're putting it on the blockchain. And we saw the first money market fund, tokenized money market fund in 2021 in the US. Since 2023, there's been a number of products, both in the US and globally. So I call this, and I've seen this, it's sort of the third wave of fund evolution. You had mutual funds, obviously, decades ago. More recently, you had ETFs, and now you have fund tokenization. So I think there's obviously not just limited to money market funds, but it is a natural thing for money market funds. And what does it provide? It provides benefits such as the ability to offer an enhanced liquidity, so 24/7, every day of the year. It streamlines settlement, basically instantaneous. And also, one of the things that a tokenized money market fund, for instance, relative to a stable coin, for instance, a money market fund can still offer yield, a stable coin can't. So this is how it would distinguish itself from being a stable coin. So there are a lot of opportunities for tokenized money market funds. I think you're going to see more and more all over the world. Regulators are also seeing this as a way to attract assets. We're seeing it all over the world. They're looking at this and trying to make the regulatory framework clear and easy and to launch. So I think it's kind of an exciting opportunity.
Well, let's move on and talk about the SEC specifically. And, you know, the audience may not be sympathetic to people that work at the SEC, but having worked there, it's been a tough 4 years, not just this year, because they've been operating under a chairman and commissioners that kind of have been pushing down directives to the staff. When I was there, you know, basically the chairman's office and the fellow commissioners, they had more important things to do. They left us alone. And it was great, you know. One of the things that came out of that was the ETF when I was there. But now, you know, listening to Chairman Atkins, it's going to be back to business as usual, which is good. But one of the things that has been happening under the Trump administration in DOGE is that there were a lot of offers made to staff members, and a lot of them took those. Some people estimate IMs down 20%. Hundreds of people have left enforcement. So maybe I'll start with you, Lisa. I'm interested. You know, everybody has goals. ICI has goals, but we're working with a different SEC, or you will be working with a different SEC. How do you see things over there?
I think you're exactly right. I think it's a hard atmosphere. It's a hard time to be an SEC employee, just like it's a hard time to be
a federal employee
of any of the agencies. I have also heard stats that are staggering depending on the group. I've heard numbers, you know, 10%, 20%, even 40% of some offices, even 100% of an office. You know, I think it takes work to do all these things. You know, mutual funds are so heavily regulated, even just to read a prospectus and to give comments on the normal course of things, to put out new regulation or to deregulate, it all takes people. And so I think that with the exodus of the large numbers and the exodus of highly skilled senior people, it's even harder, right? So I think it is going to be challenging to get things done.
Yeah, I would say, especially if we're looking for the SEC to be innovative and to take risks with different things, that takes skill and expertise and seniority and confidence. And if a lot of those people walked out the door, it leaves very few people willing to take on the harder tasks of thinking through issues and working with the industry on new and innovative, products, which is exactly what everybody wants them to do that, but you need the right people.
I think that's right. And I also think, it's going to be incumbent on the industry to work with the SEC folks, whether it's educating them on an exam or helping them through the prospectus reviews or trying to get innovative products through. I've heard, some stories of people who have been through exams where the examination staff didn't exactly have the expertise that was needed. So I think that will be challenging for sure. It's not going to stop us from trying to push forward with some of our priorities, but I think it will be a busy time. And I think it will be a busy time, not just for the SEC, but like I said, for us working with the SEC and us trying to help them deregulate and help them conduct business as usual. So it will keep us busy.
Yes. Let's return to crypto briefly. And one of the things I'm curious about is there's a unwritten rule enforced by disclosure that mutual funds, ETFs can't invest directly or hold crypto directly. So, right now, a mutual fund and ETF, if it wants to gain exposure to crypto, it has to invest in a spot product like Bitcoin, ETP, like IBID. It can kind of try to simulate the price of Bitcoin through futures and swaps. You can use the CFC. These are all very cumbersome things. And they add an expense as compared to directly holding Bitcoin, Ethereum, the currency itself. We'll see if that gets permissive. There are a lot of 40 Act issues. But what else is there to add on crypto regulation that we haven't already covered?
All right, I'll start. So one of the things that we should note, as Bib was mentioning, Paul Atkins was sworn in earlier this week, and he reaffirmed his commitment to crypto. And I'll just quote what he said in his swearing in statement. He said, "A top priority of my chairmanship will be to provide a firm regulatory foundation for digital assets through a rational, coherent, and principled approach." So clearly he's ready and willing to jump into this. We're also seeing this through the acting chair Ueda had formed a task force on crypto led by current Commissioner Peirce. And so that task force has been very busy. They've been holding roundtables. They've asked for comment on a variety of issues that are still outstanding. One of the things you might remember is Commissioner Peirce was very critical of the previous administration because she thought the commission was regulating by enforcement, and that it took you had to basically read the tea leaves in order to understand what you could or couldn't do in the crypto area. So she's clearly trying her best to provide more clarity in line with what Chair Atkins would like to do. And so again, there's a crypto task force, they're holding roundtables, they're asking for comments, and they're working pretty fast. So I would expect that we're going to see something. Maybe it's a concept release, maybe it's some sort of working paper later this year, that gives the framework a bit.
Yeah, I think I totally agree. We've seen kind of a shift in emphasis. So the enforcement staff that was assigned to crypto disband or, have left that office.
They've left the building.
They've left the building or reassigned, but they're not
Drop
doing
the
that
mic.
anymore. So, exactly what Peirce said, the regulation by enforcement gone. Now it's more in a proactive, how can we get this done? Clearly it's, instructions from the top. Presumably there were conversations between Ueda and Atkins. Atkins is probably getting it from the administration. Yes. There is a clear directive to make this happen. And so I think that
Even one
it
of the
is-
executive orders from the president early on talked about a working group on crypto. So it is coming straight from the top.
yeah, I think there is this clear directive to support innovation. And so, you know, I agree with Jane. I think we'll see things very quickly.
Speaking of things coming straight from the top, ETF mutual fund share class, you know, there were public statements, I believe, by Udaya as acting chair, that's a high priority. You know, a real quick recap, you know, if this is allowed by the SEC and it takes an exemptive order to allow it, it would allow a registered fund to have a mutual fund share class and an ETF share class, thereby, you know, economizing on one portfolio of securities. And currently, only Vanguard has that ability with index ETFs and funds, mutual funds that dates back about 11 years. So there's been a lot of press on this, fanfare. You know, I used to work in that office, and I can tell you, I'm shocked that anybody would have ever cared about what we were doing in exemptive applications when I was there. But this one is very important for the industry. And what's interesting, you know, the prior Chairman Gensler obviously, I think, was against it, or at least kept bringing up issues like cross-subsidization as rationale for not letting this go forward. And it spun a couple of years. Now that has changed, what we're hearing from that office. And so why don't we, I'll start with you, Lisa. What's the latest and greatest on the ETF mutual fund share class relief?
Sure. So as you said, Vanguard was the only one to have gotten the relief, and they patented the process. So nobody else could really touch it. Then when the patent wore out, lots of folks filed for the relief. We saw in the fall, you know, over 50 applications, and then they kind of sat. There was a lot of back and forth behind the scenes with the staff, but the staff was clearly concerned about cross-subsidization. And we should point out that when the ETF rule was adopted years ago, it written into the release was, we are not touching ETF share class right now. So there was a lot of back and forth, and then Trump won the election, Ueda became acting chair. Whatever conversations happened behind closed doors, it became a top priority. And so all of a sudden we saw things really heat up to the point where I believe it was April 1st, Dimensional DFA had the first application on record. And the way the process works is you file an exemptive application, and then there's behind the scenes comments and responses between the applicant and the staff, where you kind of work through all the issues. When the staff is seemingly closer to granting that relief, they'll ask you to file an amended and restated application. Then whatever is done at the commission level or at the staff level, they notice it, people can comment, and then they issue an order and you can go to market. So April 1st, we saw DFA file an amended and restated application, which presumably indicated that the staff had gotten more comfortable, and the application set forth a number of conditions that gave a little bit of insight into the staff's thinking. After that, we understand the staff went to a number of different law firms and said, please file an amended and restated application that follows this framework. So I should back up and say that applications that had been pending, there were a couple different flavors, but this is clearly the one that the SEC is ready to move forward with, or is closer to getting ready to move forward to. It doesn't mean it got the okay, but it's one step in the process. Importantly, that application had a number of conditions, which I can go through, but it did not speak to the operations or other matters. They're really the legal conditions. So that is, like I said, just one step in a lengthy process. Since that time, a number of different firms have filed their amended and restated applications. I looked at the number this morning and now I can't even remember what I looked
40.
at. It was 40. Okay, good. Thankfully, I told Jane and she has a better memory than I do. But so 40 of those 50 applications have been amended and restated. So the next step we'll see is hopefully to get that notice and then get the order issued. And so what those applications do is they set forth the legal framework for this to be approved. And the board has a pretty big role in this. So we've been paying close attention at the IDC. And in fact, next week at ICI's Leadership Summit, IDC will sponsor a panel talking about ETF share class. So I would encourage everybody to sign up for that if you're going to be in DC next week. But anyway, so the application says if you're a mutual fund looking to add an ETF share class, or if you're an ETF looking to add a mutual fund share class, you need to follow this basic framework of conditions. And the advisor has to put together an initial report to the board for board approval. The board needs to consider why the ETF share class is in the best interest of the shareholders. So each share class is in the best interest and the fund as a whole is in the best interest of shareholders.
And they have to do this annually, reaffirm?
They have to reaffirm it annually. And there are a number of things that the SEC spells out at a minimum that they want the board to consider after receiving this report from the advisor. So the onus is really on the advisor to give a descriptive analysis of why it's in the best interest. They can't just do a data dump to the board of numbers. And so they need to look at things like the anticipated size of the fund, the brokerage costs, the cash flows, the transaction fees, you know, everything that kind of gets at what could potentially be a conflict of interest. And that's kind of the view of how they're seeing cross-subsidization, is it's really a conflict of interest. So the board will give approval, and the advisor also has to recommend thresholds, a numerical threshold that the board also has to approve. And then if there are exceedances of this threshold, then the board needs to decide what, if anything, to do. And there's, you know, notice that needs to be sent out to the board, not necessarily to shareholders. So it's not clear that these thresholds need to actually be disclosed, although disclosure of the framework will be very central to the whole thing. So, and once a threshold is exceeded, the board can, you know, not do anything. If it decides that's in the best interest of shareholders, it can discontinue a class or convert a class. It can also, you know, look at adjustments in the use of the in-kind transactions or greater use of lines of credit or other sources of cash to reduce cash drag. It can look at, you know, the tax framework and what it can do there to reduce the capital gain distributions. Adjustments to transaction fees, purchase fees, redemption fees. You know, the applications that DFA and others have filed really are very specific in laying out all the different things that the board needs to consider in consultation with the advisor. So, like I said, that's just the legal framework to get board approval to go forward. But there are a lot of different issues in the marketplace. So just practical issues, operations, issues with intermediaries. It's unclear, I guess, how much demand there will be for this structure. But I think from the SEC's point of view, they are looking to support the innovation and say, okay, industry, it's on you to figure out how this is going to work. And, you know, if it's going to work, we're not going to be the holdups. So I'm going to take a sip of water. And let Jane take it.
Sure, I reiterate that the SEC approval is just the very first step. It doesn't mean, even if they were to approve tomorrow, it doesn't mean we'd see ETF share classes right away. You're probably still looking at a pretty long runway because That's just the beginning. That's the approval stage. After that, you're gonna have to get buy-in from your intermediaries, your distribution partners, willing to not only support the ETF share class, but also to build any sort of infrastructure needed to provide, to offer that. And there's also the likelihood that an intermediary distribution partner will say, well, we'll take one of your share classes. We'll take the ETF share class. So it's, I think there's, again, industry's looking for the innovation, not sure about the interest, especially from the intermediaries and the distribution partners. I don't really know if this is investor driven so much. An investor may not really care if something's, unless they see real benefits through economies of scale, or they're able to get an ETF share class on a mutual fund product that they always wanted. But again, I think these are all issues that probably going to take some time. And also I think that it doesn't matter. I also don't believe that it matters in what order these applications are. Once the SEC approves, it'll be because ETFs are all different, and then what they're going to be doing are going to be different. It won't be like first to market. Whoever's first to market is going to win here. So,
yeah, I think with other products,
Yeah.
there's been a real first mover advantage.
yeah, I don't see one.
And the
here.
SEC has said, I think looking at its experience with Vanguard, we're gonna do something wholesale for everybody.
Right.
And that's kind of why they're going out to the different fund shops saying,
Yeah.
okay, now's your time to file a restated application. And even for those who don't have an application on file, I think it's, they could potentially get expedited review.
Very. Yeah.
So I think there are a lot of pros and cons to
Mhm.
weigh, right? You talked about economies of scale.
Mhm.
There's, I think boards are really gonna look at, okay, what would happen if we launched a brand new standalone ETF
Right.
versus this ETF share class? What kind of benefits, what are the pros and cons of each? And what is in the best interest of shareholders? And I think those are the discussions that we're kind of gonna see. And then I think the operations are gonna be a lot more discussions. I think, like you said, it's an important first step, but from what I understand, there are so many issues to be worked out that it's going to be some time before we see something actually come to market. I know the ICI has a number of working groups. I think more working groups on a single topic than I've seen before. They've broken it down in at least half a dozen different ways through our operations groups to figure out, how to work this all out.
One thing I hadn't thought about was there are some fund groups where they divide the fund trustees in terms of a mutual fund board and an ETF board. So
Right.
this could be an interesting issue if you're offering both shares for a
Absolutely.
product. So that could be a rejiggering because you often have expertise in one area. So
Yeah.
I guess that's a consideration. So lots there.
Yeah, and I think what's interesting too, this is not totally novel because mutual funds have share classes. And I remember when the Merrill Lynch application that allowed the first, class A, class B, class C. And obviously those continue to exist. So, complexes with mutual funds with share classes those boards may have a leg up because
Right.
they already understand, it's obviously a little more clear cut, but, one class can't be disadvantaged to another class. And similarly, when these products are sold, I think we all remember a lot of the B class cases. So, this is going to put an extra burden on broker dealers if they're selling a particular fund to their customers that has two classes, an ETF and a mutual fund class, which class is appropriate. So, every
Just pick one and only sell that one.
Right,
Yeah.
right. So like everything, everybody's focused on this exemptive order, and throwing the big party once that's granted. But like both Lisa and Jane has said, there's a lot of work to be done after it clears this hurdle. So we're at the close, and I was gonna throw out a couple things. I mean, number one, if there's anything you'd like to discuss that we didn't cover, and then number two, for whatever reason, I feel optimistic about ETF, mutual fund regulation, over the next several years, and I'm curious if either or both of you share that optimism.
Yeah, I absolutely do. I think it's an exciting time for the industry. Like you said, Atkins has a deep understanding of what we do. He speaks the mutual funds, and it's a new, exciting time for someone like that to be at the SEC. I think we'll have more collaborative interactions with the SEC, both with the staff and the commissioners, and so I think that's going to be great. I think that going back to the basics is a great thing. I think it's needed, and it's kind of predictable, right? To be able to know that you've got to get your disclosure right, you've got to get the basic processes right, and you don't have to worry about an examination staff coming in or an enforcement action about some one-off topic that is just the flavor of the day. I think that lack of predictability kind of throws people for a loop. It takes a lot of time and resources. And if we can focus our energies on the basic things, get back to, protecting investors, enhancing capital formation, the main missions of the SEC, I think that's a great thing. We've been long advocates of sensible regulation, and I think we're going to start to see that. So I'm optimistic.
Yeah, I am too. As a member firm, we are very optimistic. We were very pleased to see Paul Atkins when he was first nominated and now confirmed. We are very excited about a pro-growth agenda. We're seeing that both in the US and globally, which is a pretty interesting and a nice change of pace after COVID, where we had a lot of, again, sort of like after the financial crisis, there was a lot of de-risking and a lot of highlighting on funds in some ways unnecessarily. And now I think we're seeing a back to the basics, pro-growth, pro-capital markets stance, and again, across the board. So we are very much looking forward to working with Chair Atkins, the rest of the commission, and having a really productive relationship. We've always had a great relationship with the SEC. They're fantastic, the staff, but we're looking for even more engagement and a willingness to talk through issues. So,
yeah, I think the staff is really hardworking. But sometimes, with different administrations, there's a hesitancy to engage because you don't necessarily know what you're going to get, and things quickly escalate to enforcement actions. So I think getting out of that mindset will be welcome.
Yep, I would agree.
Great. Well, Jane, Lisa, thanks for sharing your insights. I'll add in closing that this will be available on YouTube. So probably next week. So if you came in late or you want to rehear something, you can find it there. You can always email me. I think everybody viewing it now will get an email with a link to it. But thanks again for joining us. Have a great day.